Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
All right, we still have the auto workers on strike. It seems like the strike is expanding in scope. Doesn't seem any closer to a solution here. Question is, what does it mean for these companies and their balance sheets? So we got Joel Levington here. He runs all credit research for Bloomberg Intelligence, and his day job, he follows these auto guys and the industrial companies from the credit perspective. So Joel, when I think of the auto companies, I don't think of them with the strongest balance sheets and strongest credit profiles. And if this strike goes on, is it a risk here, or what type of risk is it to their balance sheets and to their credit?
Yeah, Paul, no, it's a great question. And really, the U.S. companies autos have weaker balance sheets to begin with than the European names. It hasn't really been too much of a concern at this point, but as it extends, right, we're already in week 6, it becomes an issue. And really, it becomes an issue because the payables on these companies' balance sheets are huge, in excess of $30 billion, and you don't really have receivables to offset that. So you have this liquidity issue of...
You already lost Matt Miller on that.
Yes,
receivables, payables discussion.
Payables, like you're paying your suppliers every 60 days, and as you have no sales, like you still have to pay them. On the flip side, remember, they're selling to their dealers, so they get the cash kind of up front. So that cash...
right?
Yeah.
Because when you sell a car to a dealer, you don't get cash for it, right?
Right. Well, it's done through usually done through floor planning.
You're owed.
So, well, essentially you get it very quickly. And so there's a timing mismatch. You get the cash up front, and then you have to pay your supplier. So when there's no more sales, or when sales decline, you don't have the money coming in because you're not selling to the dealer. But on the flip side, you still have to pay your vendors. And so that's where all the cash drain happens. If you recall, during the pandemic, Ford had to issue $8.5 billion worth of debt, which is very high coupon debt, which eventually they called in at a premium on top of that, just to keep their liquidity whole. So, hopefully that's not the situation we're in, but certainly it feels more uncomfortable
Well, when we
every
get
day.
Into next year and we look back, I'm sure the strike will be resolved in the next few weeks. Seems like they're done. They just need to strike a little bit longer.
Is that right? Is that kind of the feeling?
That's what I got from your interview with David Welch this morning,
Yeah.
Which is that Sean Fain has to make a lot of noise. He had huge demands. They're going to get a big pay bump, but obviously not the pensions or the 4-day work week.
I was rooting for the 4-day work week.
Yeah, I thought it would be awesome. 4-hour work week is what I'm for. But when you look back at the second half of 2023, how much of an impact is this going to make on the top line?
Probably not that much. I mean, I think particularly with Stellantis, so like your Hellcat and Dodge and Chrysler, they built inventory in front of this, knowing that there might be a protracted.
They built a lot of Jeep Wranglers, we heard, ahead of this.
I mean, if you go to the Salerno, Dodge
Salerno
Salerno in our town, they certainly have a lot on their lots of Broncos and Rams and Jeeps. So
Wranglers, you mean?
And Wranglers, yes. And so
Broncos are Ford.
No, well they have two.
Oh, I see. Okay,
there.
they have two stores.
But yeah, like all the autos had lots of inventory on their lots. Knowing that you might have a several week lack of supply coming out.
So wait, just to sidetrack on the Bronco thing, you got a dealership in your town that has a ton of Broncos on the lot?
Yeah, man.
Do you go in there and are they charging $5,000 or $10,000 over MSRP, or can you actually just buy one? I
think you could just buy one.
Where do you live?
We'll give you that offline.
Summit NJ. Yeah, right at the train station. Walk off the train. Yeah. There it is.
So what do you think the union is going to get at the end of all this? I mean, it looks to me like they're going to get 23% increase in pay, right? It may be bigger compounded, and but no pensions, right? They're not going to get that back.
No, I think you're totally right, and I think you're probably in the 25% zone is where it kind of works out. I think one of the reasons that you hear people like Dave Welch, who does a great job in our Detroit office, talk about it being extended is because if you think about from the UAW side of things, they've had a complete decline in volume and customers for decades, right? And they have to kind of turn it around. So if you can pop a 15% increase in salary on day one, that will get other industries and other autos to be on notice that if the UAW is in town, certainly more people could join them, which is really their goal and game to become more
They're
profitable.
signing
on
up
their
battery
side.
factories now. I'm sure they hope that some Tesla shops will look at the union and say, you know what, let's try it again.
Yeah, and all the non-union shops down south or in the west.
BMW.
BMW, Volkswagen is building a new $2 billion Scout facility. So I'm not sure if anybody's
That's
going
going
to
to happen?
But
Is
that's
that
happening.
really going to happen? I saw at the import mechanic in Bronxville, right around the corner from Rosie's, they had an International Scout on their lot, and I thought, man, that is cool, so cool. But
You have no room in your parking garage.
No, I don't.
Anywhere.
I know. But I feel like, is it really going to happen? Is Volkswagen really going to revive that brand and actually make a mass production product?
They are, although if you look at the products that they've shown online, it looks very, very similar to the Rivian products.
Yeah.
Just with a brand name that nobody remembers.
But is that going to live? Is Rivian going to live?
Rivian, I think, can live. Like they did a convertible bond a couple of months ago, which really gives them some liquidity in time for their next product to come out. But just like all of these EV companies, they're years away from making profit. So it really becomes what's your liquidity and access to the capital markets for more of it, because you're going to need it.
Let me ask one more stupid car question, then I'll yield the floor. The Cybertruck, Elon Musk on the conference call when he was so bummed out and getting kind of philosophical and dark, he said we never should have, launched into this special product, and we should have known that this special edition would have caused us to go back into production hell. He was talking about it as if it were limited, right? Don't they want to challenge F-150, Chevy Silverado, Ram 1500, these, massive volume products with huge margins? Isn't that a market that they want to take a piece of? Or is this just like, if you got one in the 2-year production run, you're lucky and then it's done?
I don't think the Cybertruck is the answer to the F-150 or the Silverado. I think really what they're trying to do there is really work on gigacasting, which is really making these huge casts. And when you can do that, you can really cut down production time really quickly. But I think where Tesla is headed is really towards the Toyota side, not towards making SUVs, not necessarily making a lot of money off of a pickup truck, but really on the smaller cars. And I think you'll see that with the Model 2. That's where I think they can get super high volume and get it out to the largest amount of consumers, right? Their business has always been about the retail person, not the consumer, not the commercial application like you'd see in an F-150. So I think that's really where they're headed. But having that ability to cast in great scale at a short period of time, that can give them a competitive advantage even against an amazing manufacturer like Toyota.
GE. GE's back, baby, after like a 10 or 20 year hiatus in terms of being a stock and a company that seems to be headed in the right direction.
It cost me my hairline, but they are back in action and doing really well. And I think there's potential rating upgrades, which should enhance views of their bonds. They will be separating their energy business in the second quarter of next year, or probably at the end of the first quarter. And that really will keep it as a pure aerospace company. And by all metrics, they should be back into the A category for the first time in 5 years. And their bonds do not reflect that. And so that's been a huge winner this year, both in the stock market and in the bond market.
Yeah.
And I think that can continue into next year.
I'm just looking at the FA function for GE. In year-end 2019, he had $94 billion of debt. Now they've got like $24 billion of debt.
It's amazing if you think about what they did with the finance company. At one point, I think at their peak, they had about $500 billion worth of debt outstanding, and that's been whittled down to the 20s. About $20 billion today from almost $500 billion.
So GE is back. It's just a shadow of itself, though, in terms of size.
They have skinny down to the core business of aerospace, and they are really, really a strong player in that business with a lot of aftermarket products and a 20% margin with very little capital intensity. So that can be a huge home run for investors.
All right, and who's the CEO? We like this guy, Larry Culp?
Larry Culp.
Yeah,
he was great at Danaher and has done a tremendous job at GE.
See, it can be done. So, Jack Welch, Jeff Immelt, no.
Joel Levington.
Yeah.
We got to get this guy in the studio for like a half hour.
I know.
You know?
He's right. He can talk about
I have
anything.
a million questions. Let's go to break so I can ask him some more questions.
All right, very good. Joe Levington, he's the Director of Research at Bloomberg Intelligence.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Matt, Sam Bankman-Fried to testify at his fraud trial. Can we see this on TV? Is this stuff televised?
I mean, when I saw that headline crossed, I was so excited because sheerly because of the drama.
Yeah.
You know, the decision I find questionable, but I guess I get it. I mean, it's reportedly, it's not always the smartest move to make. On the other hand, some people have said he needs to throw this Hail Mary because he's losing the game.
Right.
You know? Then I got kind of bummed out because I remembered, as Katie Greifeld was talking about on surveillance today, there's no cameras allowed.
Yeah.
So we've seen everybody else who's not in prison who comes to testify, right. But we haven't seen Sam Bankman-Fried, and the court sketches are, I mean, horrendous. I know it's subjective, but they're no bueno. They're just not realistic at all.
Yeah, we need to get some cameras in there. I'll see if I can make a phone call there.
He's got a haircut, and I need to see it.
You need to see the haircut.
Tom Keene was pointing out, no one cares if he gets a haircut. That's because we can see it all the time.
Right. Exactly.
You know?
All right, we had some tech earnings last night. We're going to get some more the remainder of this week. You got Amazon still to go after the close mañana. Let's check in with Angelo Zino. He's a senior industry analyst at CFRA Research. Angelo, we had last night Alphabet, better known as Google, and Microsoft report some numbers, and it seems like for both companies, it's all about the cloud. Give us your takeaways from some of those big-name tech names last night.
Yeah, no, absolutely. It is all about the cloud, at least, you know, after seeing those numbers. I mean, Alphabet was a disappointment on the cloud side of things, sharp deceleration. I think well below what anybody anticipated at a 22% growth rate. We were looking closer to 26 to 28%. And, you know, they're clearly losing share to Microsoft and Azure, which saw actually an acceleration of their cloud business, growing 29% from the 26% growth rate we saw just last quarter on their end of things. And listen, I mean, as far as Alphabet is concerned, they are a much smaller player on the cloud side of things. So they should be growing above the growth pace of Microsoft. And the fact that they're not is a big problem. I think the other issue with Alphabet as far as the numbers were concerned is as you start falling behind the competition, there's always concern that you may need to spend a little bit more to kind of keep up with the pack. And I think going into 2024, there could be some concern that, you know, maybe Alphabet will need to spend a little bit more than what consensus out there is anticipating. So that's probably what's weighing on the stock significantly. And then on Microsoft side of things, I'd say it's as good a quarter as you probably could have gotten, executing again on the cloud side, like I mentioned, but also when you kind of look at Office Commercial, growing, you know, high teens growth percentage pace, and then, you know, Copilot launching next week. It gives them all the momentum in the world kind of going into the December quarter and into calendar 2024, as they seem like they are kind of the clear leader here on the AI side of things.
Yeah, I mean, a leader on cloud, right? And a leader in AI, both places that Google seems to be dragging. I mean, I note that Sundar Pichai over at Alphabet says, I'm pleased with our financial results and our product momentum this quarter with AI-driven innovations across search, YouTube, and blah, 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 blah. I don't see any AI-driven innovations there, and it's possible, it's likely that they're there and I just don't notice. But isn't that important? The marketing side of it important? Are they doing anything with artificial intelligence?
Yeah, I mean, listen, one, they are kind of ahead of the game in terms of the infrastructure that they're building, at least as far as kind of their internally designed chip, right? Their TPUs, which they were way ahead of the game on that side of things. So, you know, in terms of kind of getting a lower cost structure from that perspective, I think they are ahead of the game. But and listen, just like, you know, Meta, which is going to report after the close today, they are going to be a leader in terms of kind of you know, leveraging their AI into, you know, improving kind of, you know, the back end, getting, you know, search generative experience in terms of, you know, their search business, as well as, you know, implementing it into YouTube here over time. But yeah, I mean, to your point, at the onset here, kind of early days, it doesn't look like that Alphabet, at least kind of early on, is executing and implementing some of the AI capabilities across their ecosystem, maybe the way Microsoft is doing on their end, or what potentially Meta is actually doing with some of their rankings and recommendations on their end as well. So definitely kind of, investors want to see more out of Alphabet, clearly, given the stock performance here that we just haven't seen yet on the AI side of things.
Well, how about on the Meta front? Again, reporting after the close. What's the street really looking for there? I mean, again, a digital advertising play like Google. Stock's up 156% year to date. What's the Meta story here? Is it all cost cutting, or is there still a cloud play there as well?
So listen, I think I wouldn't say there's a cloud play here, but as far as kind of Meta is concerned, I mean, the growth rates are accelerating here into Q3 and Q4. We're looking at digital ad growth, for them to eclipse 20%. And you look at Alphabet's results, right? It wasn't all bad. They actually did see some nice search numbers, some good YouTube numbers. So the digital ad, the ad space is performing fairly well. I think, maybe there is some concern about what guidance is going to look like here in Q4, given some of the comments made from Snap last night in terms of, what's going on in the Middle East. Although I wouldn't expect, much negativity on that side of things right now. But maybe to your point, I think all eyes is going to be on the cost side of things. More along the lines of what 2024 is going to look like. They should give some indication here, like they did last year in terms of on their call. We do expect, a big hike on the CapEx side of things. But if OpEx, for instance, is north of $100 billion here in 2024, that's going to cause the stock to see a negative reaction. So I think all eyes is really going to be on the OpEx number here tonight.
All right, Angelo, thanks so much for joining us. Angelo Zino there from CFRA, talking to us about the results that we've seen and those that are coming.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, interest rates are moving higher. I thought that's good for net interest income for the banks. We've seen some big banks put up some big net interest income numbers, but it also impacts the value of the bonds on their balance sheets. I forgot about that part of it. Herman Chan joins us. He's a senior analyst. He doesn't forget anything.
Never forget.
U.S. regional banks and fintech. He covers it all for Bloomberg Intelligence. So, Herman, talk to us about this rising interest rate environment. What does it mean for kind of the regional banks out there in the United States that most of us do our banking with?
Right, sure. So higher rates typically are better for banks, but they need to be moving in a slow, measured fashion, with rates whipsawing that they did earlier last year, this year. That has proven to be a bit more volatile for banks. So you saw the benefit of that last year when interest rates rose, net interest income rose for the banking group. Now those benefits are being pushed back to consumers and business customers as deposit costs are rising. So it's been a double-edged sword on the rate front. You mentioned earlier that higher rates means higher unrealized gains in their bond holdings, and that's happening, and that's weakening book value.
By the way, Herman, so when I think of these bonds that are underwater back in March, right, I imagined regional banks using April, May, right, June, July, and August to get rid of those holdings. Why on earth would you still want to have zero coupon treasuries?
Well, the issue is that if you sell the bonds, then you crystallize the loss on their balance sheet, right? So that the banks don't want to do that, especially ahead of tougher capital rules and tougher capital requirements ahead.
Okay, not all of it, but don't you try and minimize your underwater bond portfolios?
You can do that in a few ways. You can hedge. So some banks have done that, which is good to see. So any future rate movements will be less pronounced on the unrealized losses, but some haven't, and maybe you could say they dropped the ball on that front.
So they're still holding these. They haven't found some greater fool
They-
to take those portfolios.
They have not. They're just waiting for these underwater securities to mature quarter after quarter.
Wow.
All right. So what's the stock market doing to the regional bank names? Are they just throwing all of them out the window, or are they trying to find winners and losers?
At this point, it seems like there's a lot of negative sentiment out there. And we've seen a number of banks in my coverage universe at 52-week lows over the past week or so. So we talked about weaker margins. There's not a lot of loan growth as well. And then we haven't really seen the decline in asset quality that's coming ahead for the regionals in terms of exposure to office properties and the like. So unfortunately, there's a lot of headwinds, and it's hard to foresee some of these headwinds going away over the next 3 to 6 months.
Is there a valuation call here where, I mean, these things have been trading forever. There's great history to see how these names have traded. Is there a floor where people just say, boy, if it gets to 0.8 book, I'm just holding my nose and buying these things? Is there
0.8?
Yeah, I don't know.
Try 0.4.
Maybe 0.4. Is there a point? And if so, where are we relative to that point?
Yeah, we're probably around like 1 times tangible book value, which historically has been a very low valuation.
In this country, because I remember I spent years in Germany.
Right. It's different across
where
the pond.
one is like, wow, if only I could have 1 times tangible book value.
Deutsche Bank would love that, I guess. It's different across the pond, but here in the U.S., 1 times tangible seems to be closer to a trough valuation. The stocks did bounce off of those lows, in May and June, but now we're sort of back towards that trough level. So there is. I would also point out that historically, some of these stronger banks do grow through M&A in periods of weakness. So if you see some further turmoil for the space, some of the stronger players do transact in M&A to get bigger at very attractive pricing. So that's something that could happen over time.
I'm just wondering about loan growth, because Torsten Slok, the economist over at Apollo, was out with a note a couple of days ago, and he had saying basically there are 33 million small businesses in the United States, which I didn't know that number. That's good to have in the back pocket. But their average borrowing cost has now reached 10%.
Right.
At 10%, am I taking out a loan to expand my business or to start a new business? What are your banks telling you?
Yeah, they've talked about that very point that banks, that bank clients and business customers are delaying investing because of the higher rate environment. They've talked about potentially waiting for spreads to tighten a bit more, which may be a bit wishful thinking at this point. So you have seen less demand across the regional banking space by business customers because of the higher interest rates.
Yep, very good. Herman Chan, thank you as always, keeping us up to date on what's happening in the world of the regional banks across the U.S.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Bryan Whalen joins us. He is the co-CIO and Generalist Portfolio Manager at TCW in the fixed income group over there. They got a couple shekels under management, so we always appreciate getting Bryan's thoughts. Bryan, again, we got yields moving higher, and I guess what kind of got a lot of people's attention over the last week or so was, boy, you don't have to just stay in a 2-year and get 5%. You can go all the way out the curve now to 30% and get 5% on the U.S. Treasury. What do you make about the movement in rates we've seen recently?
Yeah, it's been brutal. It kind of got kicked off this summer when the Treasury announced higher anticipated, debt issuance, and that just kind of unraveled. Volumes have kind of ebbed and flows, but it just kind of feels like a market that nobody wants to step in front of, regardless of the value that at least we see, and I think a lot of others are starting to see. As you said, all the way across the curve at this point.
So, what has to happen before you can be comfortable getting back in here? I was thinking about when I was a kid, I used to be so bummed out that I missed buying like 17% 10-year treasuries.
Yes, exactly.
Right in the early 80s. And I always thought, wow, I wish my parents had bought more of those, before I sort of understood how it all worked. Am I going to look back at this moment and think, I wish I bought 5% 10 years?
I think so. I do. I remember the same feeling. I'm hearing about people buying, 17% strips. way out, the curve in duration and this incredible total return in the bond market. I don't think we can promise that. The math just doesn't work that way. But I would tell you, think about 5% across the curve. Think about like what that's telling you in terms of like, the bond math. It either means that we're going to be here at a 5% funds rate for the next 5 years. It's Goldilocks, for a decade, or it means that the Fed still got to raise rates significantly from here, hundreds of basis points, only to then unwind that by a lot more on the way down, so that over the next 10 years, you average 5%. Both scenarios seem pretty unlikely to us. So it seems like, 5% on the Treasury curve looks like great value, and something we always try to remind ourselves is, you can't time the turn. More likely than not, whether it's a multi-kind of standard deviation event, some sort of financial accident, so to speak, or it's just kind of the natural kind of organic letting the air out of the economy and seeing unemployment start to rise and consumer spending start to come down. Either way, when the turn comes, you're probably not going to be able to kind of catch that. So it's best to start kind of adding now, dollar cost averaging in, getting long, understanding that you may be some bumps and bruises along the way, but over the long term, it's going to provide a really nice return for you.
Well, let me ask a similar question. It's kind of the same question a different way. I got a viewer or listener writing in asking if you have a rates view here. Are we higher because of technical inflation and stronger growth, or is it fundamental structural change in ownership of rates and issuance to remain very elevated?
I think the latter, the whole issuance thing, is a little bit kind of like finding a narrative to fit the price action. I mean, historically, there is no correlation between issuance and the way rates move. You can see periods where there's issuance is high and rates go higher. You can see periods where issuance increases, but rates rally because of the more macro event. I think we're here because, let's be honest, the U.S. economy has been stronger than people expected, and so the Fed's had to go higher. We haven't seen anything break yet, outside of a few regional banks, earlier this year. And so I think there's just a fear that it might take more to kind of slow this economy down and bring inflation back down toward 2%. But the house view here, TCW, is that, that fear is more about kind of looking through the rear view mirror as opposed to kind of looking forward and understanding that all this monetary tightening, not just here in the U.S., but globally, it just acts with a lag, and people get impatient. But, this lag, whether it's from the time the Fed started hiking or when the curve went inverted, there's nothing unusual about it. They say it's a lag for a reason, and this has been consistent. And I think it's just going to take a little bit of patience to pay off.
But if you look at, so one of the other things I started doing after the regional banks broke down is looking at Debt Go on the Bloomberg to see who's holding all this U.S. paper. And I just can't imagine that previously it was always like the Japanese and the Chinese and all these foreign investors were buying our treasuries. You watch the dysfunction in the U.S. government and the fact that even in a strong economy, we want to have $2 trillion deficits. Like, why would any foreigner want to hold this paper?
We're good for it.
I two things. One, first of all, we pretty much always run deficits. That's nothing new. And we're always dysfunctional. We're just the least dysfunctional out there, or one of the least. And so I don't, that doesn't hold a lot of water for us. I think more relevant to the reason we haven't seen foreign investors buying a lot of U.S. treasuries or agency mortgage-backed securities has to do with the fact that the hedging costs have been so high. And that really relates to where short-term interest rates are, and that's been set by the Fed. So as the Fed's taken rates from 0 to 5%, it's become very expensive for non-U.S. investors to buy our debt. However, if we are at or kind of very close to the peak in that rate, more likely than not, the U.S. dollar over time will start to come down, the hedging costs will come down, and the value of U.S. treasuries at 5% or 4.5% or 4%, it's going to actually start to be more appealing to the non-U.S. Investor.
I like we've always run deficits. It makes me feel a little better because in my house, it's the same. I've always spent more money than I make.
See, I just tell the world we're good for it.
But at a certain point, it's got to worry you, right? Stephen Major wasn't worried until he was. And at some point, it's got to be we're borrowing too much money, no?
Yeah, it's got to work. And you know what? It's the little bond vigilantes. It's where that's come from. And at some point, the bond market's going to raise rates. And it's gonna make the interest costs such a high burden that we're going to have to fix our deficit problem, and we're going to have to realign spending. We're going to have to be more frugal, with our pennies. And so it kind of feels like we're getting there. We're seeing the percentage of interest cost as a percentage of GDP jump here, and if we continue to hang at these rates, it's going to have to force some very difficult decisions in DC. So, more than likely than not, that's coming one way or the other.
All right, Bryan, let's get to the important stuff. Yale football. Yale is 3-3. They welcome into New Haven this weekend the Columbia Tigers. Tell us about Yale football this year. What do you got?
What a great program Tony Reno's got over there. He came in years ago and he took a program. He's made it one of the best in the league. We won the title last year, as I'm sure you know, and all your viewers know that. This year, it hasn't been as good as last year, but they've got a very, very solid offense. And I think we're going to turn this season around and win on out, which includes, winning the big HYP and finishing with a victory over Harvard right before Thanksgiving.
Good stuff. Good stuff so we like to watch Ivy League football. A lot of fun. Looks like there's a lot of parity in the league this year. All right, Bryan. Great stuff, buddy. Thank you. Bryan Whalen.
I love going to an Ivy League football game.
Oh, it's great.
I will say.
Yeah, it's fun.
Yeah.
You should go to, where you live, you should go to a Columbia game. That's actually pretty close. And that's a great stadium, too. So Bryan Whalen, co-CIO, Generalist Portfolio Manager, TCW Fixed Income Group.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
As Matt just mentioned, the Wall Street Journal breaking the story just earlier this morning that Israel has decided to delay its invasion of Gaza, presumably to allow the U.S. to move some additional missile systems into the region. We want to check in with somebody who kind of knows how this stuff is done, and that's Jack Devine. Jack is the president and founding partner of the Arkin Group. Before that, he spent 32 years at the Central Intelligence Agency all over the world, so he knows how this stuff gets done. Jack, what do you make of the news here today that it appears that Israel is going to delay, we don't know for how long, its invasion of Gaza?
I think we have a balancing task here. I think on one side, the faster you go in, the quicker you suppress Hamas, the better it is in terms of controlling them before they get dug in deeper. At the same time, you have the world looking at the situation, and you're bound to feel pressures coming at you. And then the really balancing problem is the hostages. And I think everyone is trying to do the best they can to maximize the number of hostages, and hopefully all. And I think that's the balancing trade. The military part being getting it done quickly and so on, and getting the hostages. So I think there's a balancing act. I don't think it can go on too much longer, though. I think that this delay is probably one that the Israelis felt was within their limits, but I don't know how long they can hold off.
They do seem to be losing momentum. I thought they were going to go into Gaza. It was reportedly imminent 2 weeks ago. I get that they want to soften targets inside there. That's the terminology they use. But it seems like world leader after world leader has flown over to Israel to try and get them to put this off, to try and get them to breathe in, breathe out, and think about what's about to happen. Is it possible that tactic works and we don't get a ground invasion in Gaza, or do you think that's a foregone conclusion?
I don't think the Israeli political life can withstand that. In other words, you had such a massacre impacting not just the immediate victims, but their relatives and the spirit of the country. I think if you walk away without Hamas being destroyed, I think there'll be huge dissatisfaction. I don't think it's in Netanyahu's character to settle for that. But I do think they're trying to be smart to make sure they've done everything they can to try and deal with the world opinion and pressure about the situation. But at the end of the day, I don't think it's inconceivable to me that you have a ceasefire. So
to me, the hostages,
I think the bullet has to be bitten. And I do believe there were some natural delays. I mean, they weren't in position. I mean, they were not really set up to do the invasion. So that takes a little time, and then you have to soften it up. But I think this is from where I sit. It looks to me like they're well within reach of going in and doing what they have to do.
To me, the hostages
But
raise an interesting
the
question.
delays work against them.
Yeah, I wonder what you think about, Erdogan today said he doesn't think Hamas is a terrorist group, but it's difficult to look at what they did on October 7th and not call that terrorism. We do not, at least as a public policy, negotiate with terrorists. So what's happening here?
Well, you have Erdogan, but you have many other leaders. You have the head of the UN. I mean, it's very disappointing. I mean, if we can't distinguish between massacres and slaughtering and trying to defend your country, I mean, and our universities, it's to me, it's shocking. And I think we have to, when this is done, reevaluate where we stand. I do think there's an opportunity. There is a silver lining if the Israelis succeed, as I think, which will be to get rid of Hamas. I mean, it'll spring up again, but there'll be a breathing period to look at some longer lasting peace arrangement. But right now, it's stunning to see.
Yeah.
I don't know how you get there, to be honest. It's and I just feel you must have been out of touch and didn't watch any news or listen to Bloomberg when that massacre took place. I mean, it was savagery.
Jack, what role do you believe currently the United States military and intelligence is playing as we speak?
I mean, Israel's been a long-time ally, certainly our principal ally in the Middle East. I suspect we're doing everything we can on the intelligence front to assist. I also think militarily, I don't see boots on the ground. I do think there are risks having the fleet there, but I think it's the right move. And I think we're showing strength so that we're really trying to contain the Iranians rather than dealing with anything related directly to Hamas and Gaza. The Israelis will take care of that.
All right, Jack, thank you so much for joining us. Really appreciate you jumping on here last minute. Jack Devine, he's a president and founding partner of the Arkin Group, a 32-year veteran of the Central Intelligence Agency. We always like getting a few minutes of Jack's time when there are breaking geopolitical events, and there seem to be plenty of those these days.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we've been talking about rates a lot over the last several weeks. How about this rate? The bank rate, 30-year fixed mortgage, 8.04%. Are you kidding me? Crazy. I feel like a rock star now with my 6% mortgage I got earlier in the year. We also had new home sales today. They don't care about the rates, up 12.3%. After a decline last month of 8.2%, so kind of all over the place. Let's figure out what's happening in the residential real estate market. We do that with Kate Kaminski. She's the COO of Walton Global. Kate, give us just kind of an overview here. It seems like with mortgage rates this high, who can afford to buy a house these days?
Well, thanks for having me on, gentlemen. Excited to be joining you here and talking about this today. That really is the question. Who can afford to get into homes with rates at where they're at, up 5 basis points from a week ago, and we don't necessarily see the light at the end of the tunnel yet. But I think the stats that you just referenced, the 12.3% that we're seeing up in September, we're really bullish on new home sales and production right now. You're seeing new home builders that represent about 35 to 40% of today's new home sales, which is up from 15 to 18% before. And we're attributing that primarily to these new home builders very aggressively buying down mortgages for these buyers. The typical consumer is they feel that 5% is about the average mortgage rate that they should be paying, and these new home builders are putting in programs whereby they're getting those new buyers down from 8% to 5% through different mechanisms of rate buy downs.
So how does this work out, Kate? I mean, what do you what do you do at Walton Global, and what is your expectation for Q4 and 2024?
Yeah. So we're a global real estate investment and asset management firm, and we specialize in land. We're looking to buy land that's in the path of growth, that is primarily intended for sale to new home builders. And so we're a pretty critical part of the supply chain, we believe, in the new home building space, because we're selling to these builders who are really focused on that first-time home buyer. And so Walton creates pretty creative financing mechanisms, off-balance sheet financing mechanisms for these home builders who are looking for ways to keep as much cash on hand, keep their margins high so that they can do things like these rate buy down programs and deploy their excess capital, which these home builders have a lot of that right now. They've been waiting for this opportunity to expand their market share.
But
so, like I said,
sorry, forgive me because I don't understand the ins and outs of this business so well, but these new home builders are subsidizing mortgages for buyers because rates are too high, and you are subsidizing the loans to these new home builders to get your land because the rates are so high. Like, at some point, the buck's got to stop, right?
Well, we think that it's going to continue on. We think we have a few more years of this. And
I just mean somebody at the end of the day has got to pay for it, right? So, you can't continue to find creative financing solutions. Like, at some point, it's got to get paid for. So how does that all? It's like a house of cards.
Yep. Well, we're definitely seeing the increased price of resale homes, which is why, again, we're focused on that new home build market. I was just traveling in Florida last week, and there are still places where we have new communities that are going up, being built by the public builders, and there's homes in there selling for $200,000 and under in some instances. And so I think that drive to affordability is critical. We need to be focusing on that right across the country, so that we're matching the home buyer with what they're earning and what they can afford. And so, we've got a real lockup in the resale market right now because we've continued to see the value of those homes increase, and that's just not sustainable. I completely agree with you. But so that's why we continue to think that the new home building space is going to be where these buyers are fleeing to. We have a fundamental undersupply of homes in this country. Depending on what economist you speak to, it's between 2 and 6 million homes that we need to build because of the underbuilding that was occurring after the Great Recession. And so, these new home builders are where the affordability lies.
So when you're out there these days, what's the cost of land that you guys are looking at? What's the deal? What's the deals you're looking at today versus maybe 4 or 5 years ago in terms of acquiring land?
Yeah, that really is specific to every market that we're in. We are looking for land that has is in a development-friendly municipality or county. That continues to be one of the biggest challenges that we're seeing across the country as well. These areas where growth is coming, not wanting to accept this growth and provide the necessary approvals. But that's where the opportunity lies. And so we focus on areas where there's access to infrastructure, and we've really got pro-growth governments in and around the area that are going to help get these off the ground. So, there's not a specific price per acre that we're focusing on because that varies by state and per region. But we really focus here at Walton in the Sun Belt, the southern smile of the U.S.
Yep.
Because of those major market trends that we follow: job growth, population growth, net domestic migration. It's a pretty simple equation. And that has been our model for the last 45 years that we've been doing this.
Who do you compete against? Because we've heard this same, strategy on the real estate side from basically everybody in the home building food chain. So it's got to be competitive when a parcel of property comes up and, suburban Dallas or suburban Austin or suburban Tampa, I got to think 10 of the smartest and most well-capitalized people are in there trying to get that land. How competitive is your market?
So it's definitely a competitive marketplace, but where I would say Walton's niche is that we're buying land that's a little bit earlier in the cycle. Most of your builders today, because of what happened after the Great Recession and the long duration that it took for everything to normalize, they all have pressures from Wall Street to keep land off their balance sheets. And so they're looking for land that they can be building and selling homes within 24 months. And so they're compressed on what assets they can actually purchase. And even many of the land bankers and groups that they work with, they have a pretty short time horizon for when that land needs to be cash flowing, aka homes being built and sold to third parties. Where Walton comes into play is we have a little bit more patient capital. Not too patient, but a little bit more, where we'll buy land that is a little bit earlier in the cycle and we'll hold it while that home builder is doing the entitlement work, getting it ready to literally stick a shovel in the ground. And that's the time when we'll transfer the land to them. So it's pretty unique in that space and where we find the opportunities.
All right, Kate, thanks so much for joining us. Really appreciate it. Again, talking about some of that commercial real estate development. Kate Kaminski, COO of Walton Global.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.